How does an oil shock tied to Iran ripple through your portfolio? And what does a 3-week slide in U.S. stocks tell us about inflation, interest rates, and earnings? The S&P 500 just logged its first 3-week losing streak in about a year. The trigger was a jump in oil prices linked to heightened geopolitical risk. That move hit risk appetite and revived worries about inflation and margins. Trading turned choppy in bonds and currencies, signaling a more cautious backdrop for equities and ETFs. When crude rises fast, it often lifts some energy names but strains the broader market. Higher fuel costs can squeeze household budgets and push up input prices for companies. That mix pressures valuation multiples and forces investors to rethink growth versus inflation. Inflation and rates are back at center stage. Gasoline and logistics feed directly into headline inflation. Even if core inflation stays steadier, markets trade the headline. That can shift expectations for the path of interest rates and the timing of policy changes. Tighter financial conditions then weigh on growth-sensitive stocks and longer-duration assets. Rate-sensitive areas, like certain technology names, real estate, and highly leveraged companies, can feel the pinch. Firms with strong balance sheets, pricing power, and consistent free cash flow tend to hold up better. Earnings quality is the next test. Rising input costs challenge margins. Companies with hedging programs, diversified suppliers, and the ability to pass costs through have an edge. Those that compete mainly on price face tougher choices. As results roll in, listen for guidance on demand resilience, inventory levels, and cost control. Cash flow discipline will matter as much as revenue growth. Sector dynamics will likely split. Energy producers and some equipment and services firms can benefit from higher commodity realizations. Airlines, transports, chemicals, and parts of consumer discretionary may struggle with fuel and feedstock costs. The net effect can be more volatility at the index level, even if select pockets outperform. Here's the practical takeaway. Stress test your portfolio for higher for longer rates and elevated energy costs. Favor quality balance sheets, durable cash flow, and real pricing power. Check your exposure to fuel-sensitive industries and understand how your ETFs tilt across sectors. If you add energy, know whether you are buying producers, pipelines, or services, because their sensitivities differ. Keep a cash buffer for flexibility, and stick to a disciplined plan, like dollar-cost averaging, rather than chasing short-term swings. For deeper detail and charts, read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.